Have you been surprised how negative the stocks, yours in particular, and the sector have reacted to what should be a great environment for banks?
Well, I'd say coming into earnings, the whole sector ran up a lot, and we were up at 17% at one point, amongst the best of all the banks. We published very strong earnings for the fourth quarter and the full year, and had a great guide for next year. And as you say, the stocks sold off quite a bit since then. I think part of this is just retracing that. We had a lot of hope that the Fed would move up and that the 10-year the curve would steepen, and that would benefit banks. And I think when the market's pulling right now, the 10-year is retracing somewhat, and so maybe the banks' stocks got a little ahead of themselves. And so we're just kind of finding a new level here. I mean, we're still going to be up where we are now, about 7% year to date, which isn't so bad in this market. I would describe this really, Will, as just a wobble. I think the conditions are set for a very strong economy. And so we're calling 4% GDP growth for the year, unemployment going down to 3.5%. There's huge liquidity on the balance sheets of companies with individuals. Credit outlook is very, very strong. And so we think there'll be a pickup in loan demand. We think the rates will be helpful. So you put all that together, and we're pretty confident this is going to be a very good year for us and for banks in general.
The other thing a lot of people have been focused on this quarter, Bruce, has been outlook for costs. And I know you've got the HSBC acquisition to put through the books. If you're able to strip those sorts of one-offs out, what is your outlook for costs year over year?
Yeah, so interestingly, what we've done consistently is we've had these series of top programs, Tapping Our Potential, where we look to take out 100 to 200 million per year in efficiencies. And we've gotten really good at that. We just announced another program for this year of about 100 million. Those programs allow us to invest in our business, invest in going digital, invest in technology. And so while still keeping the overall rate of growth of expenses under control. So last year, if you strip out the acquisitions, we had about a 2% expense growth rate. And this year going forward, without the acquisitions, we're looking at about 3%. So we're doing the job on expenses. We're not shorting the pot. We're making the investments we need to make. One of the things that you can see is that our capital markets revenues for the quarter exploded. We're riding the wave of private equity having lots of money. They're putting that to work. They want to buy middle market companies. And so we're able to source deals and make an M&A fee when a middle market company wants to sell themselves, make another fee when private equity buys them and needs to finance the transaction. So there's some very good secular trends that we've invested in over years and assembled the pieces to really kind of ride the revenue wave there. And I think that's going to continue throughout this year.